So let's start figuring out where Jack went wrong in the last session. We're going to go over a quick introduction to volatility here. And to begin with, we have to understand what drives volatility. And at its core level, volatility is really driven by market sentiment. That, of course, is what drives the price up and down. And so to understand volatility, we have to understand all the different things that can infect and change market sentiment. So those are things like new economic data, new innovations from a company, a product release, or if you're in trading a drug company, new drug release that's coming out. Leadership changes in a company, leadership changes in your government. Herd mentality. This is where people are following the herd. Right now, as I record this, we're in a strong bullish market, and we have a lot of traders that are just following the herd. Political changes, changes in interest rates, the Fed getting involved and monkeying around, currency fluctuations, and on and on and on. The point being is there's almost an innumerable amount of elements that can change volatility and market sentiment. And so rather than worry about that, what we need to instead do is focus on how we can react to volatility, how we can control the elements that are within our ability. Volatility as a term has unfortunately become synonymous with price swings. If you say it's a volatile market, you're obviously, or you're quickly thinking about how far the price may go. Unfortunately, what volatility really is a study of probability. Because what we're really talking about is how likely is a certain stock or a certain option to fluctuate in price. If we can understand the probability of a future price movement, then we can start establishing a better risk profile. Remember this, I've said it in many of my classes. If this is the first time you hear it, write it down. If you can manage the risk, the profit is going to take care of itself. As traders, what we really are professional risk managers. And so understanding the probability of future price movements gives us a better, more clear picture of steps that we need to take to control our risk. If there's a very small chance that there's going to be a large price fluctuation, then the risk is not as great. However, if there's an event coming up like earnings and the price could go wild on us, then we have a lot of risk and we need to make sure we take care and we're mitigating it. So, professional traders constantly monitor risk. And we can do this by measuring the historical volatility, that's a key word, the historical volatility, and applying some simple statistics to it. All right? Then we can establish a model that'll analyze future probability of those same swings. Here's what's important though. We're about to get a little bit nerdy, and I don't want to lose you, so make sure that you're not going to get lost in the math here. This isn't about statistical analysis and how well you can do averages and all that, because all the information is given to you in your charting or in your brokerage applications. What I want you to understand is how we get to these numbers so that you're able to use the information profitably and not just see it as another number or another box to check off in your trading plan. So if you're ready to jump in, let's understand volatility and specifically how it impacts stock price movement.